please focus on this. Stocks have major fluctuations. Don't do any investment just because somebody else does. It is very difficult to watch your stock go down and see that big negative number on your account.
Oh, I would say the stock would probably be at $300 or $400 a share.
Intel has taken a beating in the last year. It's up a lot in the last couple weeks, but so is the market. So of course, guys, a stock going down doesn't necessarily mean it's a bad investment. If you look at any given stock, any given year, 2, 3 years, apart from the last 3 or 4, stocks have major fluctuations. They'll go up and down. When it comes to value investing, you are buying a piece of a business. If Mr. Market tells you that he's in a bad mood that day and he wants to sell you stock at a cheaper price, it is very difficult to watch your stock go down and see that big negative number on your account. I have that with Intel, right?
Same.
So we're sitting here, and again, don't buy Intel just because we do. Don't do any investment just because somebody else does. Take some advice from other people for a process, because that's what we're trying to do here. We're trying to teach a process. We're trying to teach you how to fish, not give you fish. So we're going to use our 8 pillars. We're going to look through Intel. By all means, follow us if you have the software. So let's just pull it up right here. Now, Intel is building a $20 billion factory just an hour and a half south of here. Actually, maybe an hour and 45 south of here. But look at this, guys. Here's one thing I want you to see. This is 2000. Intel is yet to hit its price from 2000. This is something I show a lot. So if you're new to the channel, please focus on this. This is proof that stocks are a voting machine in the short run and a weighing machine in the long run. The votes were going up and up and up for Intel and tech here, and then it crashed, and look at what happened here.
August 28th, 2000.
August 28th, 2000, the all-time high of $75. Back in 2000, the company brought in revenue of $33 billion and profit of $10 billion.
Today they're doing
most recently,
nearly $70 billion in revenue.
They brought in 78. So let's just look at before the big fall. $78 billion in revenue and $21 billion in profit. So if I told you back in 2000, the stock is 75, that revenue would more than double and profit would double, would you have told me the stock would never hit that high?
No, I would say the stock would probably be at $300 or $400 a share.
Exactly. But in the short run, they're a voting machine, and the long run, a weighing machine. It was overvaluation here. People were just paying too much money for the stock back here. And that's what we want to teach you. Don't follow the hype. It's funny. I am now back here. I was like everybody else. Maybe not back to here, but like here, I was like everybody else. I followed the hype. I said tech is better. I said innovation's better, disruption's better. And then I learned my lessons. Now I see this and I'm going to go, ooh, I want to stay away from that. And people usually see this and go, hey, how do I get attached to that? And that's what we want to avoid. So let's take a look at some of the things that make Intel interesting. On our software, we have some main metrics here we do. So guys, keep in mind, Intel reported much lower revenue.
Yeah.
And a lot of chip businesses are reporting lower revenue because demand has fallen and it was hard for them to supply the chips.
Especially in the computer space, the computer PC demand has fallen too.
So it's going to be a tough road for these chip manufacturers. Here are some things I do like. 5-year return on invested capital, 11.1%. Mo, look at this. 1 year free cash flow, negative $13 billion. They've really taken a hit to their free cash flow. They're investing a lot. Pull up their cash flow statement.
They are really investing a lot. Yeah, I mean, they were 12 billion, 14.5 billion.
But look at their cash from operations really plummeted.
It did, yeah, it did.
Look at that change in working capital there, minus $10 billion. Yeah. So guys,
they're really going for it.
Yeah, so they're going to have some issues. Intel is a long-term turnaround play. I definitely understand it's a hard one to go at. I'm looking at Intel for a very long-term play. That's my when I say long-term, 4, 5, 6, 7 years. You might sit there and say, I'm not willing to wait. That's fine. But I still want you to watch this video to understand how we look at businesses.
So when they started doing this, announcing it maybe 9 to 12 months ago, Paul Gelsinger came out and he was saying how this is going to be this way through 2025. So they have a plan going.
And who's
forward.
Paul Gelsinger?
The CEO of CEO of Intel. Sorry.
Here's the deal. Look at this dividend. Can they support this dividend, Mo? 5% and it pays out $6 billion. They had negative.
I guess it depends what cash flow looks like this year.
But they've already said they're going to have a difficulty with cash flow.
Yeah.
I just have a hard time seeing this happening. Man, look at this.
By the way, it's Pat Gelsinger. I don't know why I always.
I was going to say. I was like
Paul Gelsinger. I was like Gelsinger.
I remember thinking to myself, I'm like, I don't think his name is Paul, but I'm like, you must have known it. So I was I must be wrong.
Pat Gelsinger.
5-year PE 6.7.
Yeah.
1 year PE of 9. So look at the cash flow versus the income because they're investing a lot. So income in the last 12 months showed $13.3 billion. Actually, what was the cash flow? I think it was around there.
Cash flow was 13 point.
No, negative 13.3.
Negative 13, that's right.
So that's a big, and look at their change in, look at their capital expenditures. Absolutely skyrocketed.
Now, looking at their cash flow going back the past decade, I have to think that they're going to get back to that type of cash flow at some point, sooner than later.
So this chip industry has a estimated 12% compounded annual growth rate for the next 10 or 12 years. This is a situation where all ships are going to rise. A rising tide raises all ships. Maybe Intel isn't going to be the leader, but as the pie gets bigger, they will still make more money. Even if their share of the pie gets smaller, let's say they're 1/4 here, and then they end up being 1/8 here. This is still bigger than that. Yeah. And that's the key here. Some people will sit there and say, well, I want to have the number one company in the industry. You might very well be true, but Intel's still a great chip. And they're building this $20 billion factory in Ohio that's going to manufacture a lot of chips.
I'm going back to 1989. They have never had negative free cash flow until 2022.
So
that gives me some.
The question is, how good is the cash flow going to be?
True.
Now look at the market cap, 121 billion.
Yeah.
Let's say, I just look at this saying single digit free cash flow is less than 12 billion. When was the last time they had less than $12 billion in free cash flow?
Let's go check.
Apart from this last year.
Just a shade under 12 billion in 2017.
Okay, so I'm looking at this going, hey, and what was their revenue then?
Their revenue was 2017, 62 billion.
So still lower than it is today.
Yep.
Man, I just look at this saying,
and that
okay.
was pre-craziness of COVID, pre-craziness of skyrocketing PC industry.
Look at this profit margin, 46.6 gross profit margin. Bottom line profit margin, 5-year average is 25.
Solid.
Last year it was 19%.
Solid. There's a lot of really good things here.
Let's see what 8 pillars look like.
Some things that are worrisome, but
oh, interesting. So cash flow, obviously.
It's funny. Everything that we look at bad, it almost goes back to the spending that they're doing.
It does. Except for this, the net income growth.
That's true.
But there could be more I don't know. The whole point is this does bother me. And even the revenue, even though there is revenue growth, it's not by much. $300 million over the last 5 years.
This. If you take out 2019 you shouldn't really take out, but take out 2020 and 2021, that these numbers just kind of spiked and skyrocketed.
Yeah.
They are in line with what they were pre-pandemic. So that's a good thing.
Yeah, actually,
maybe it's just coming down.
It's lower than it was pre-pandemic.
The one thing I don't like is it's much lower than this. And
that's what I mean.
That's
what I mean.
That was a big jump though.
That was a big jump. Was the revenue a big jump? From. All right, so let's look at analyst estimates. What are analysts assuming here? All right. Now, again, take it with a grain of salt because these analysts are always, bribed. They're expected to make $2 a share this year and $3.50 in 2026. Not going to say good or bad. Revenue growth, they're only going out 1 or 2 years. So there's not really much to go on with analysts. So let's go look at Stock Analyzer tool.
It's going to be a tough one.
It will be a tough one. But I'm going to do a 20-year analysis. Mo's going to do 10. I think 10 is a great number because it's a long-term, but I think the next 3 to 5 years are going to be tough. So that's why I like the 20-year, because the next 3 to 5 years, I have to account for that in my 20-year analysis. What we're trying to do here is determine a value using some assumptions about the future and not including the balance sheet. That's a big factor here. Whenever we do a stock analyzer tool, it does not include the balance sheet.
Right.
To go back to the balance sheet real quick, from a high level, let's go to the main page. The market cap's 121 billion. The enterprise value is 192. So there's almost $70 billion in net debt on the company. That's a lot, but you have to factor it in and sit there and say, are we okay with that? I don't know. Let's see if it even falls in our spectrum of where we want to be for this company going forward. All right. This is a doozy. Yeah, this is a tough one. Okay.
Yeah, it might be a little bit high. All right, let's see. I might actually change this one. All right.
Now, I beat this up a lot more than I usually do, okay? I did 3, 5, and 7 on 20-year revenue growth.
Years.
That's 20 years. Guys, big companies should grow 4 to 7% a year just naturally based on GDP growth, income growth, et cetera. So as long as they're not sucking 3, 5, and 7. Profit margin. I went lower than even last year. I did 17, 20, and 23 over the next 20 years. Guys, in the last 5 and 10 years, they were here. So even my middle number is 20% below where it was. Now, free cash flow, I increased it because the free cash flow has really been hurt in the last year that really affected a lot of these numbers. PE, I put 13, 14 and a half, 16. Same with price of free cash flow. Okay. And for my returns, look at my returns, 13, 16, 19. These are big. Guys, I've never done these kind of numbers for Intel.
No.
A lot of value investors would argue this should be your like middle or base case for revenue growth. I don't know if it's true or not, but that's where I'm at. Mo, what'd you do for 10 years?
I did 1, 3, and 5.
Okay.
And the reason I did is because the computer industry coming back off of those revenue numbers. We'll see. Profit margin 18, 21, and 24. Free cash flow margin 15, 17, and 19.
Okay.
PE, this is the one I was kind of not sure on. 13, 15, and 17. Same for price to free cash flow and my returns of 12, 15, and 18.
These are all reasonable.
So let's see.
I hit the analyze button.
Oh, well, there we go.
Look at this.
More green than I expected.
I've got 30 and 38 and 35 in the middle. Guys, I just think, now keep in mind, I thought this was a buy at 50.
Yeah.
And I still do think it is a company that's worth well over 50 at some point in the future. The question is, how long do you want to wait? And guess what? Look at this. Even buying it at 30 and 35, it's expecting 20-year returns of 13 and 16% if my numbers are right. And that was being very conservative. That's why I personally believe in this. But if Intel becomes a dying company, this is a completely gone. This is going to be a $15 stock or less.
Right. I can't believe it with 1%.
Yeah, you still have green in there.
Still green in here at $32.
So guys, if you like what we're looking at here, we're sitting here and this is the art of investing. It's really hard to sit there and say what it's going to happen. That's why you have margin of safety. I've run the numbers on Intel before in the past and gotten $60, $70 in value as a intrinsic value. I still believe that to be the case. However, it's going to take some time. And again, I repeat, I put a lot of margin of safety within my margin of safety. So if I actually sit there and go and do this at,
I just put
10, 10, and 10, which is my intrinsic value, and put my margin at 20, 22, and 24, and 18, 21, and 24, and then have this at 14, and just do this at 15, 15, and 15 for my PE and price of free cash flow, the stock is worth, like I said, $60 to $70 a share.
Yeah. All I did was change my desired annual return to 10%, and I'm $30 to $75 a share.
So that's the point here. It's like you're trying to get a margin of safety. Remember, Mr. Market hates companies when everybody hates companies. That's the hard part about being a value investor. You have to sit there and be okay buying a company that everybody's beating up. I'm hoping that's Intel. If you like this, please do me one favor, subscribe to the channel. And also, if you like the software, check out everythingmoney.com. For less than a cup of coffee per day, you can get all of this and more, including our community with thousands of people in here talking every single day about investing. Money back guarantee on everythingmoney.com. Check it out. Thanks.